What's going on, guys? It's recap time. Today's gonna be a little bit different. We're gonna go over how and why and how to draw and how to predict the moves like we just did off of the deviations and gap magnets, okay? These algorithms love gap magnets. The gap and go, return to gap, no fill is one of the easiest algo magnets to play over and over. If you don't know what I mean by that, we find gaps like this that have a change of trend. We call that a gap and go. Something gaps on the chart, then it goes that direction. If this is an uptrend, and then we gap to the downside, that is a gap and go because it's a change of direction, right? We could have a gap and go in the same direction, but regardless, we'll start right here. Let's shrink these back down. Now, these algos, when they leave a gap open, when they return, when the price action comes back up from an unfilled gap, it has a monstrously high percentage chance to come to the gap and not fill, okay? Comes back down. This happens over and over and over, whether it be the top or bottom of the gap. Whenever you get a gap and go, wait till it finds reputable support or pattern out like this little higher low play that shied away the 100 EMA. And we knew it was coming down further because we never got a 100 EMA tag, which is right here. When the algos shy and leave gaps, they're going to come slamming back down, right? We'll talk about that as well. So when this gap was made, price action came down, return to gap, no fill, wash. And again, left a gap here, and again, reputable support, came back up to the gap, no fill, washed out. This pattern is one of the easiest algo magnets, and this is why gaps are the most important thing on the chart for me, in my opinion. It makes it very simple to trade these when we find support and make our targets happen, okay? So if you look at some of these other ones just over the course of time, you're gonna see just a massive amount of repeat with those gaps. So a lot of these gap downs here, some in which took quite some time to come back down, but just grabbing some of the easiest ones. This is one of those CPI Powell Dumpskis. This is a fun one. Here's a double gap right here. And then another one even here. We had a double gap fill here, pushed, created a one, came into a no fill range right here. Okay. Boom. No fill. Double fill range. Boom. No fill. Pick back up. Gap and go here. So it left this gap right here. Price action ran. Gap and go. Here's another one. Pushed into gap, no fill, wash. Another one. Now look to your left. We're coming down to this gap finally. It returned to this gap right here. What about this one? Same thing, double gap. Every single one of these gaps will return. Very rarely, and that happens, very rarely do they not return to these gaps to fill. Now, we're not talking pandemic reversal ones because there's a couple in the $160 range in SPY that I don't think we're ever going to see again. But moral of the story is, regardless of the time frame as well, this is why pre-market and after hours are so important to me for trading these gaps as well. So this gap, when we had the gap down, price action returned to gap, failed, washed out. Okay, similar here. And how did we predict this bottom, right? A couple different instances. First, we're gonna start at the best and strongest time frame, 1 year, weekly. So in the last prior videos, when we went through and we were preaching that the deviation does not allow it to go +1, -1 on the weekly, extremely rare in a 1 year time dominant, okay? Not 2, not 3, not max. The deviation needs to be 365 days consecutive. Okay, so you notice way back here, you can barely see it. -1 hit, +1 almost, +1 shy, -1, +1, -1. So obviously from regression trend is 0, yellows are +1 and -1. +2 for the green, -2 for the green, so on and so forth. That's how deviation works. So when the price action came into a multi-week failure rate, and we've seen this coming pretty early because one, it was coming from here at a +1 extension. August and September usually bring volatility. So right here, August, early volatility popped, September volatility closing through. And then October, right, here 10 starts, releases us from the September hardcore pushdown, which is just seasonality. That happens on August, September, and then deviation as well. So let's take a peek at the volume indicators here. When we already put in a top, okay, and we were looking for the lower high, as soon as the seller candles right here started closing above the current price action consolidation, so not back here, because obviously that was on the uptrend, but once we broke it, okay, right here, and we created this lower high, all the price action after this broke, okay, this pullback, this section right here, these 3 weeks into 4 weeks, those are the volume pieces that matter, those 3 red candles. And if you look, they're taller than the prior 3 green weeks as the uptrend was coming to a top. This means sellers are in control. Does this mean it's going to wash out indefinitely? No, it means you wait for confirmation. Sellers are in control, down, and what would be the pattern? Well, the +1 deviation returns to the regression center line, return to this dash line, which is the half deviation. The obvious placement between +1 and 0 is half. Okay, that's why deviation is so important. Breaks down, center, breaks up, lo and behold, damn near to the penny, half deviation, breaks back down. Now remember, sellers are in control, okay? And again here, continuation through September. Sellers are in control. Now this does get exhausted after a while, right? Especially when we come into support. So for this 2 months, we've seen this coming, right? Volume and deviation. Now when we breached into the -1 on the 1 year weekly candle, that's when things got interesting. We preached that. Check our old videos out. The last 5, 6 cover this bounce point over and over again. Let's move down to the daily chart, okay? What do we see? 666 moving average, something huge that we use here. 200 EMA was a break. I'm not a big fan of that one, but I do love the 666 and 200 SMA. And we have gap magnets on trend. Look at the trend, okay? Look at this daily chart trend. Look how smooth this is. Top, lower high, lower low, lower high. So we were coming into the lower low section with a mass amount of support. Okay, -1 on the weekly, 200 SMA, 666 SMA daily. Those are absolutely massive, okay? And what is the best case scenario for that? Well, it returns to the gap for a no-fill. So this was a very, very limited risk-free zone, as was this with the shy. And I said I'd talk about this a little bit. When you see price action not hitting a moving average, we call that shying here, right, in our group. So when the price action never comes down to an absolute tag of something, make sure it shies it. It will slam down back into it eventually. So don't get all overzealous and, short into this little piece looking for the 100 EMA daily, looking for the couple little points left. Wait for it to retrace, grab that confirmation, and all the way back down. Now, again, on the daily chart here, look at your volume. You were engulfed right here on this micro gap and go here, and that was it. Right here. That was all said and done. It was going to create a new low after sellers took control right here mid-September, right? And we actually called 915 and back in those videos where we had the under 50 SMA daily confirmation, and we needed it to be after 915. Here's 915. And I called this way ahead of time, was the candle to be under the 50 SMA daily halfway through September. I said short as much as you can, 915. If it's under the 50 SMA, that is your rule. Well, look at that. Literally the day we called, which complete accident, just happened to be that way. Now, cycles into another gap. Now let's talk about what it does here. So we had the shy at the 100 EMA. We needed to come back down and actually hit it. Did we hit it? Nope. Double shy. Even missed it on the bottom side. So we had a gap through. Came down to this huge red day, had a gap and go again. And this is what brought us to believe here's the support that we just went over. And that was going to be our target. And again, check our prior videos. It goes through all of these way before they happen, because these are how algos read. Now, we had this beautiful dump from the 15 all the way down to then October came, right? And this is when we get out of September volatility to the downside and potential support pressing back up in October. We ended the Friday, and Friday the 13th historically is a pretty bad day, and we ended up into the gap, okay? So we had this whole thing, if you check out our prior videos, on this bounce in just a very reputable amount. I said I was gonna sell a whole bunch of puts down here at 418 and 420, which I did for the week, and capitalized immensely on that swing since I was out of town for cancer treatment in Minnesota. So I did, however, play those puts and a couple little day trades with you guys. Now, let's get back into some of our day trading time zones, which we like to do on the 30-30 and so on and so forth. Now, this chart does not have this gap on the intraday, so I'm going to draw this out real fast for you guys so you can see exactly what I need you guys to see here on these algo blips, okay? So this is our gap. Let's make this transparent real fast. All right. Now we can see through it. Now, this price action, we'll do 5 minute first here, is super important during CPI. Now, this is the gap. The algos bought this up and scammed it up all the way to the tippy top of the gap, okay? But what do we notice here? We're in pre-market. So that doesn't mean jack, right? We need live tags. So as CPI came out, we were at the top of the gap, okay? This was the first initial tag into it that we knew was going to fail. Had the secondary wash, had a monster squeeze back up. That was the trap. It's so obvious. It pushed to the pre-market and after our gap. So again, you're not going to see this on a real daily chart because it's not live trading time yet. CPI hit right at the top of the gap and of course launched it down. A ton of us stayed short there and then just panicked out, right, for that Thursday. That was massive. That was perfect, right? And nothing goes in a straight line. So that first gap fill tag was the initiative saying, hey, we're not going to fill this gap. It's going to go down. CPI was the trap, bringing it to the gap. Wasn't going to stick there. CPI was going, it doesn't matter what it was going to do. That was a huge technical monster right there. Down she went, okay? Okay, into now a secondary tag at the gap, and this is exactly the trade plan was. It's hilarious. We said long biased above a higher low from yesterday, push to the gap again, fail it, and wash out for Friday. Literally to the T. We got it. It couldn't have been any cleaner. We cleaned house with a really nice set. Now, let's look at the next inning. I like the 15 to the 30-30 here, guys, okay? 30-30. Again, the same rule applies to the deviation markers. It's rare, but less rare in the 30. So the weekly, damn near non-existent when you're weekly, getting outside of those deviation ranges. 30-30, it can travel outside of the deviation a little bit because it's a faster time frame, right? So we start looking at halves, but reputable enough, you see the center line here, +1, fails, -1, support, -1, support, -1, support. We had a really easy pickup here on that 30-30 as we started accumulating there, and that's what led us all the way back to the gap fill. So remember, the deviation half on the weekly support, this is how we called it right here. We even said on this day right here, we said, how funny would it be for data to come out on non-farm and payrolls and everything else in jobs to wash it back down into a moving average support and then just shoot it right back up to go chase the gap down because of the weekly deviation. Doesn't even matter on news, hype, fear, and greed. The technicals were just way too powerful here. Now, the last couple of days of trade, Thursday and Friday from CPI and down, the gap tag, that's perfect. It continued right back down on the 30-30, and the deviation markers played out accordingly. And what do we mean by that? These are ever calculating, so this was a little higher. But notice here's that +1. And zooming out here into that plus run drain, it's very, very minimal we start trending outside of that range. Very. And if it is, it's like same day, early morning, full push. And then when it consolidates, the deviations slowly tend to recalculate and catch back up. And that takes time. So when we seen it coming up into the +2, very close to is back here, because it recalculates, and then we had the half right here. That half deviation was max, and then we've seen obviously data open up right into the top of the gap, which was a no fill. That was not going to stay. So washed out for the day, another gap tag, and down. So this stuff becomes no gap fill tags coming back around for those supports, and that's exactly how we predicted that on deviation. So deviation on that 1 year weekly, 1 year daily, extremely important because they don't come out. I know a few people that don't like to day trade, they only swing. They will literally come up to the 1 year weekly, 1 day, so on and so forth, and they won't touch a trade until it's at one of these deviation points. Literally months at a time, just like, whatever. And they'll come from, let's say, -1. And they'll say, oh, it popped up. Okay, we got 1, 2, 3, 4 weeks of potential upside. If it gets above the regression trend, we have another couple months back up to the +1. And then they're going to go, oh, well, that's my profit take zone. Once we start getting close to here, let's start looking at a short and selling calls out here into the half. Well, got 2-3 months worth of that coming all the way back down. Now, again, we're stuck in the same rut. So what do? Well, I think consolidation to further long, it's still the play. I don't see us not carrying into the end of the year for, depending on earnings season, of course, a little higher, okay? And last but not least, I just wanted to go over that to show you guys all those prediction videos and how they kind of come to fruition here. We're going to look at the 1 year daily and the VIX as well. And this was another big incantation and a big help for us on the VIX because we read this like a book day in, day out, volatility index. So on the daily chart right here, again, deviation markers are extremely important. We have them coded on the intraday. So if I go into my 5-minute here, we obviously have a intraday and trend lines here. You can see them all the time, so we know where they're at on the inside of the chart. So you don't got to go back and forth to the yearly and daily. And we sell all these custom scripts. You can check out our Boiler Room Trading Teachable. All of these things are super handy. But look at the confirmational. Okay, so let me back this up one more time. Okay, 1 year weekly, we have some really big trend lines that come in. I'm just going to max it out, actually, get you back there where we got it from 3 years back. So these are 3-year trend lines weekly, okay? We have them way back up here. Now, these are the 2 trend lines I decided to take for confirmational bias on when the price action of the VIX gets to these trend lines to respect and hold these very tried and true. They're orange and green, okay? So we get down into the 5-day 15 or 5-day 5-minute, which we like to look at. These trend lines are extremely important. Let's take a peek where they come in on the 5-day and the 15 for the scale, okay? Look at the scale. As the VIX was coming back down, market was rallying into the gap, hits the gap, goes for the CPI dump. Where did we hit? This is the orange trend line right here, okay? Green one's a little bit too far away. But once we popped above the orange trend line, it needs to come back down and confirm, right? So back to the daily real quick here. Price action snaps over. Okay, here's the rejection of the last orange. Here's your orange. price action down, rally, snap over, back test. Snap over this one and a lower band, back test, and right back up, okay? So those trend lines are meant to be used. See that big wick on that trend line, big wick on that trend line, whenever the VIX comes in. So you could even 30-30 the VIX once in a great while. We'll look at this. We like to use it for day trades, but the 30-30 on the VIX here also gives you those orange hits, right? And it has an okay scale at this. So it breaks over here, dips through a little bit, recovers orange, big push, dips through a little bit, big recovery. And these trend lines respected for a long period of time. So when these swings come in, we just have to start matching the volatility index, the dollar, and the market with these massive bounce points from moving averages, deviation, and a hidden volume. Whatever volume bar is taller, that is the control. And that's literally it. So I hope that lesson made sense, and tune in for the next.